Go.
Welcome back to Academic Markets Insights. Today we have a special treat for you. We're going to be discussing how buffer protected ETFs. So, this is a very timely topic. This is definitely something we wouldn't necessarily cover in the classroom. So, we're excited to be able to do this for you here. So, with that excitement, I'm going to pass it over to my colleague, Dr. Rowe.
Absolutely. So, wow, sounds like something's going on your end over there. So, I just for a little bit of context, and also I want to say what the date is because that's actually going to have something to do with some of the charts I show. Today's actually standard option expiration for April 17th. And I was just at the CBOE Risk Management Conference, which in 2026 was down in Nashville. And it's always, when I got to work there, it was one of those things that I felt really honored to get to go to. And I really appreciate that they let me still go. There were three topics that came up that people said maybe we need some more education out there. This is the first of those three. It's buffer protect ETFs. Buffer protect ETFs have an option like payoff, and that's why they were discussed at SIBO. SIBO is involved with a firm called Vest Financial, which really, I think, kind of revolutionized these things in the United States about a little less than 10 years ago. And they're one of the biggest issuers of buffer protect ETFs. So, what the heck is one? It basically is an exchange traded fund that's going to give you some limited upside, and it's going to buffer some of your downside with exposure to an index. More often than not, the index is the S&P 500, but as I've been digging through all of this, there are over 400 buffer protect ETFs outstanding now. I found them on gold using the GLD ETF. I know they're on the QQQs. I know they're on the Russell 2000, and I actually saw some emerging market EEM ones, which may make sense for emerging markets with as volatile as they are. But most of them are lined up with the S&P 500. And they actually use flexible options, which that's probably a video in itself. But they can get customized options based on implementing a position basically at no cost. And typically they will put on a position a year in advance. So I mentioned today is April 17th. It's standard April expiration, which somebody at the SIBO conference said, yeah, this is standard expiration week. I can't believe we're having a conference. I don't think half the room knew what standard expiration was anymore because we have so many
Right.
expirations. But they do use the standard third Friday options. And this is the third Friday in April of 2026. The positions for April of 2027 will be determined on the close today. And that will that's it says usually a year. It's off by a few days depending on how the expiration calendars. Were you trying to ask me a question?
I was for a number one fan. What is the standard expiration date?
Standard expiration date was the original option expiration date when options were first listed by SIBO, back in the 70s. And the idea behind the expiration date being the third Friday of the month was it's least likely to be a market holiday. Every 4 to 5 years, we have a Good Friday that falls on the third Friday of a month, and then standard expiration will be on the Thursday. But with the advent of technology and customer demand, we now have options expiring every single day. So and that's why I kind of joke that I don't think everybody in the room knew what standard option expiration stood for anymore. It's kind of a relic. I know some of my undergrads were not aware of what that topic or what that meant. And what I have here is a funky looking payoff, kind of similar to something that Dr. Ademiak asked me about a few weeks ago. We were, you sent me, I think like four options that looked like a spread trade, and the outcome looked kind of like this. And you said, "Is this something that people do?" And like, yeah, kind of. I mean, they were creating their own buffer protect, and that might be a video in its own right. creating your own buffer protect when you want to time it on your own time frame, as opposed to paying a management fee to have somebody else do it for you. Now, this it's just a very generic, just to give you an idea of how these things work. You can have more upside, you can have less of a buffer to the downside, etc. In this case, I'm just saying that somebody has the S&P 500 or some sort of an index, and they sell a 10% out of the money call, and maybe they're able to buy an at the money put and sell a 10% out of the money put, and do all of this at no debit or credit. And when I describe how these are actually constructed, you'll see how they end up going about backing into doing these at no cost. So in this case, if I were to buy this buffer protect and structure and it expired in a year, if the S&P 500 is up more than 10%, my gains are limited to up 10%. The S&P 500 is down 5%, my losses are zero. It's flat there. If we have a catastrophic event and the S&P is down 20%, I've actually only lost 10%. So I've buffered 10% of that downside. And that's where that name comes from. You also hear the phrase targeted outcome. But buffer protect, I think, is a good description because it says what it is, which is you get protection from some of the downside, not all of the downside. So this is the description of the U.S. moderate buffer ETF that expires every March. And you can see the inception date is 3/17/23. That was standard expiration in March of 23, and they used March of 2024 options. It's standard expiration in March 24. They used March of 2025 options, and then they used March of 2026 options, which recently expired. They rolled to on March 23rd, 2026, and you can see this in the fund objective at the very bottom, they rolled from to the March of 2027 options on March 23rd, 2026, again, which was the third Friday standard expiration. They also, or after the, just after the expiration, they were able to guard against the first 15% of losses, which means they bought an at the money put, sold a 15% out of the money put, and then based on the difference between those two, they sell an out of the money call. And in this case, they were able to sell an out of the money call 14.1% out of the money. So if I were to have purchased this on March 23rd and I held it to March 29th of next year, the most I can make is 14.1%. I'm guarded against the first 15% of losses. And, you know, the payoff structurally looks like this, except it's 14.1 and then it's 15%. Sure. There's one expiring every month. And if you go to the Vest site, you can download, they've got hundreds of these. I just did the moderate buffer, which gives you the first 15%. And you can see, you know, the one that expires next on May 15th of 2026. It was capped at up 11.48%. It's got a buffer of the first 15%. However, it's already up 10.9%. So if you were to buy this one, this top one, you're not getting the buffer protection at all. You're actually just getting, you know, about 0.5% of upside. It wouldn't make a whole lot of sense to buy that one. And that's the biggest caution on these funds is make sure, you know, very few people are actually going to buy it on the day that they roll and hold it for the full year.
Sure.
And when I show a performance chart in a minute, I'll describe why you probably wouldn't want to do that. But you want to make sure that you're not, it doesn't make a whole lot of sense to buy G May or G June. You like the symbols?
I do. Yeah, I do.
It's so I like that an awful lot. It's very helpful. You wouldn't want to necessarily do that. If I were worried about right now, if I were worried about maybe a sell-off between now and the end of the year, but I want to be able to participate with upside, the one that expires in December, it's only up 2.9% right now. So if I were to buy that one and it sells off 2.9%, then I would start to get some protection. The January one of that year, it's only up 1.86%. So you're pretty close to getting some of that buffer protection. You've also still got some decent upside to 10.97%. But one of the things, and one of the things that came up at the conference when people were talking about this, is sometimes people may buy something that they don't really understand what they hear that, it's, I get the next 11.48% of upside and I get 15% protection. Well, that was as of May 19th of last year. That's not as of, and I'm speaking to you on April 17th of 2026. So you want to pay very close attention to where you are with respect to the cap, and when the buffer starts to benefit you. And each of these cases, when they were issued or when they did the roll, the buffer protected you starting from 0% to down 15%. So, any questions on all that? I jumped through a lot of hoops, and
again, I'm also very learning.
Okay.
This is a really unique product. Obviously, it's been around for a couple of years, but what a great way to, again, buffer against some of the downside, especially if you would like to capture the upside. So I would probably be the anomaly who would get into one and hold it for the year. Because I have concerns about the market, and so this might be a way to temper that while still trying to achieve some of the upside returns. But I'm curious to see what you came up with the P&Ls.
Well, so I did because conveniently today is option expiration day. So on the performance side of things, I took a look at, because today is April expiration, the last day of the current structure of this one. It's getting rolled into a new structure for 2027. You can see that the SPY has greatly outperformed this. And you're like, well, if it's capped, why didn't it just run right up to the cap? Well, it's capped with a short call option. I know.
Okay, got it.
So at a certain point, if the upside, and on this one, I believe the upside was around 15% or so. If the upside's capped at 15% and you've got 6 months to go and you're already up 12 or 13, you probably want to get out of this and maybe get into another structure. And I haven't looked at the shares outstanding and everything on these on a rolling basis, but it'll be an interesting thing to look at and see if when at a certain point, when you get close enough to the maximum upside, do we see a lot of people exiting these, et cetera? It would make sense to. I mean, it's again right here. If you own the May one, you've got very little upside and no downside protection. If you have any concerns whatsoever about the market, you maybe want to get out of this and be in cash, or maybe you want to get out of this and just rotate back and forth between the SPY. That's something to keep in mind as well. Also, we don't have an example of this, but if we were to own one of these, and if we have the April roll and all of a sudden the S&P 500 sells off a good 5, 10, 15%, the April is going to hold up fairly well for you, because that one does, because that one's relatively new. And if you want to buy on weakness, you own the April, and then when you've got a certain profit on it, you rotate out of that into the SPY. So I feel like that would be a good use of that as well. Either if you want downside protection, get to this table and compare what kind of protection you're getting versus what kind of upside you have over different time frames. For me, I would probably look at February or January, because there's a lot of room in there right now
Right.
relative to where the cap is. But also do keep in mind that if the SPY, when it takes off on you, just because we got that first 10% right there, and this is rebounding from the tariff stuff last year. But if you had buffered, if you had bought the buffer ETF, which came on, which was, it was priced right around all of that tariff stuff. Now that I'm looking at that, and that would explain some of that outperformance. But if it takes off on you like that, and all of a sudden you don't really have much downside protection again, you're probably going to want to roll this into another position or another instrument. Let's see. So, mentioned these have grown an awful lot. In 2020, there was 5 billion under management. There's 80 billion now. In early 2020, there were a few dozen funds. They're in the 400 to 450 range. I've seen estimates that the feeling this market could grow to the 350 to 600 billion level. What's really going on here is a reaction to bond diversification not working for people anymore.
Okay.
And that if you're like, where did this rapid growth come from? People were very discouraged by the lack of diversification that you got with bonds and stocks in 2022. And they're looking for another way to have equity exposure with less volatility, moderate upside, et cetera. If you diversify yourself with bonds, you're probably diverse. You're probably just based on an average year looking at 6, 7, 8%. If you can get into one of these, you're looking at something in the low teens more often than not.
Well, and these are similar to the structured products that are so popular with CFPs.
Exactly.
Yeah. And I
And
can see that market really growing because it's achieving all of the things that a CFP would want for their client.
oh, absolutely, absolutely. And you don't necessarily have to pay a CFP to do this for you. I should say that the management fee per year is 0.85%. It's a little higher than normal.
Okay.
Which for something that needs to be actively managed like this, and you're like, well, they set it and they go. Well, that's not necessarily true. If people start to get out of it, if the assets under management if that April one that I showed you, if after the first month people are like, well, heck, the market's up, I'm already up 10%, I want to get into a different fund, it's very possible that several of those could be redeemed. And if they get redeemed, the issuer will have to trade out of those options. So there is an active management component to this. There really is. But being very aware of what you're getting without just blindly buying, guarding against the first 15% of downside, but giving you 12% of upside. Make sure you know where we're at relative to that outcome. So with that, that's a nice intro and high level look at Buffer Protect ETFs. Do you want to take us home? Because you're very good at that.
Well, we're so thankful that we had this conversation because this is a product that's going to be very important, particularly for those who are looking to diversify away some of their risk. As discussed, this is going to be a topic that's going to be even more important in financial planning. So thank you so much for Dr. Rowe for sharing that with us, and we thank all of you for hanging with us for this video. And if you enjoyed this video, please hit like. If you have questions about these products, please put them in our questions. And if you're not already a subscriber, please subscribe. We thank you so much.